The beauty of being a business owner is there are certain expenses that you're probably already paying for, but now that you are an active, profitable business owner, you can legally take some of these expenses as deductions. In fact, Warren Buffett's famous for his quote. He's famous for a lot of quotes, but one is, the most important skill, wealth building skill that a business owner needs to have is proper allocation of capital.
So, hey, we spend $1 in marketing, we should get $10 of gross profit back for every dollar spent.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Welcome to the Business Coach. I'm your host, David Finkel. Today we have a special treat. I'm joined again by guest co-host Kevin Bassett, CPA. As you know, for those of you who are regular audience members of the Business Coach podcast, you've seen or heard Kevin share his background. Starts off as a very skilled CPA and owner of a CPA practice for 25 plus years. Kevin has helped his clients grow from the low millions of dollars to the tens to the hundreds of millions of dollars. Some of his clients are VC-backed firms or private equity-backed companies. Some are just privately held companies and owned by individuals who've scaled them to 10 million, 50 million, $100 million or more in revenue. Kevin is a business owner in his own right who's owned multiple companies, and he and I are going to riff today on the following subject. How do you intelligently take money out of your business? How do you know when to leave the money in to reinvest? We're going to first of all come from a tax perspective. How do we pay ourselves tax efficiently, tax intelligently? That's Kevin's deal. I'm going to let him take the lead on that part. Then you're going to hear him and I talking about our individual ways of looking at. He coaches hundreds of businesses. Our company coaches thousands of businesses to make smart choices of where to and when to reinvest money back in the business. What should your expectations be in terms of an investment to pay back for itself? What rate of return should it be able to generate before you consider keeping or putting money back in the business in some fashion? And so you'll hear us go through that as well. So we'll come from the perspective of tax efficiently paying yourself and how to pull money out tax intelligently, but we'll also talk about when it's intelligent or not intelligent to leave money in for uses in the business and when you really should be pulling it out. That's all here in store for you today on The Business Coach. Well, welcome back to The Business Coach, Kevin. How are you today?
Doing great. How are you doing, David? Good to see you.
I'm doing fantastic here. As we get started here today, we're going to talk about paying ourselves out of our companies and how to do it tax efficiently, how to do it business intelligently, and we're going to be diving into those types of things here. I'm curious, you're a big reader, you're a big learner, you're a big lifelong student. What's one thing you've learned in the last 6 to 12 months that has helped you be a smarter, better business owner? And I'll share one for me as we get started, which is I realized how many times in my past I tried to finesse situations, and that the business mentors I most admire, they gracefully but directly deal with stuff while it's small up front, even if it's awkward or socially uncomfortable. And that's something that I take as one of my lessons that I'll put out there. What's one of your lessons? Because we both believe strongly that we need to keep learning all throughout our business owner careers.
Yeah, constantly learning. Yep, I agree with that. And kind of on the same vein, I've been a lot of reading and learning about business owners that have faced some sort of adversity or setback and use that as fuel or raw material to grow and level up to the next level. And a lot of times when those setbacks happen is because we've hit another ceiling of complexity, and that's time for us to level up. So leveling up has been my theme the past year.
That's great. I appreciate that. This idea that we want to continually grow, and if I become 10% better this year, 12% better, boy, that's compounding in another way. Today, we're going to talk about paying ourselves, Kevin. And so I'm going to lean into your expertise and your background on the tax intelligent way of paying self first, but then you and I are going to get a little bit more philosophical or step back and talk about from a business intelligence way about what makes business sense about the owner paying out cash versus just letting it accrue inside the company and how to make choices around that. So start off, give us the short course, give us the short version about paying ourselves intelligently, tax efficiently.
Yep, my pleasure. All right, so I'll start with when we all start our business, we're all starting at zero or negative, and then you grow to a certain point. So for argument's sake, I'm going to assume everybody's grown their profit at this point north of the 80 or $100,000 mark of profit before you paid yourself. And somewhere along the ways, at this point, it's appropriate for you to be taxed as an S corporation. How you're taxed is relevant to how you're going to pay yourself. So assuming that you're an S corp, the IRS does require that the shareholders actively involved in an S corp need to get paid a reasonable W-2. They refer to it as reasonable compensation, which is defined as like pay for like services. If you're making at least a couple hundred grand of operating profit, then that W-2 should be at least $100,000 is what both the algorithms at the IRS when they're computing your DIF score are looking for, and it's what the IRS agents are looking for. And there can be an argument of whether you should be higher than that, but if you're at least 100, you are probably, in most cases, safe. For example, I have mine at 120 and have plenty of profit left over on that, and I have other officers in the companies that are getting compensated well. Once you've got your W-2 dialed down, the next step is you want to what we call pre-tax your lifestyle. And that means we're capturing all of our deductions that we should. And the beauty of being a business owner is there are certain expenses that you're probably already paying for, but now that you are an active, profitable business owner, you can legally take some of these expenses as deductions. Some examples would be your vehicle. You can either take mileage or if your vehicle is used more than 50% business use, we can take actual expenses for a percent of that vehicle in your business. Certain things like home office deduction, your home internet, your cell phone, things that you're already probably paying for, now we can pay for in the business. So we refer to that as pre-taxing your lifestyle. And now that you've got that dialed down, the next step is your distributions. So what we've in effect done here is we say, okay, this business is producing so much, a certain percentage of operating profit, depending on your industry, and how we're going to take that profit home. We're making so many pennies on the dollar. How we're going to take those pennies down is a tax decision. So W-2, pre-tax your lifestyle, and distributions. And then we'll go to in a minute about good ways to look at these distributions.
I love it. So I paid my reasonable salary. I've used the grateful expenses from the company that are legitimate business deductions. But if I didn't have the company, I probably would still have the expense of a car, healthcare, cell phone, etc. And then, which gives me, depending on my actual effective tax rate, federal and state, might give me 30, 40, 45, in certain states, 50% discounts on what I'm already going to spend money on anyways. You've always said, and I'm going to make the point for you, you never spend money on an expense to save 50% on your taxes. That makes no sense unless you are going to make the expense anyways, right?
Yep.
We're not going to go ahead and buy something that we don't want or need just to save half the cost of it. That's silly. That's the hoarder using a coupon just because I have the coupon and boy, I should use it.
Yep,
and then the distributions are a tax decision. I love it. Tell us more.
Yep. Okay. And then one thing I want to focus on here is it's very healthy for you to be taking distributions regularly. In fact, in my very, very biased opinion, that's literally the whole point of having a business is to generate a bunch of profit that we're going to take home. Why are we doing this? Are we running a charity? And so here's a couple of rules of thumb. So if you have a healthy cash collection cycle and healthy margins, then if your company has reached stability, then normal rule of thumb is you should be distributing 100% of that profit minus your CAGR, and CAGR stands for compounded annual growth rate. So let me put some numbers to that little fancy cocktail equation I gave you. That means for example, if you're growing at 15% a year, you would take 100% and subtract 15 from that number. That gives you 85%. So that means your cash profit, you should be distributing 85% of it as a general rule of thumb. Now, like anything, rules of thumb has their exceptions, and your two exceptions are seasonality. And if you have a large operating capital expenditures coming up, like you're going to buy some equipment and you're going to choose to make a down payment or pay cash for that equipment rather than finance. So that's kind of an easy rule of thumb for your distribution method. There's an alternative way that some folks do. If you've really achieved maturity and your growth rate's say below 20%, maybe below 15, there's another easy method called the month-end method. And the way this works is say you've come up and say, hey, I'm, running at a $3 million company, and maybe I've determined that my healthy working capital number is 300 grand, right? Some say that 10% of revenue is a healthy number. And so that means that towards the end of the month, as you've paid all of your bills for the month, you're done. And in my case, we pay all our bills by, well, like the 24th. At that point, anything over 300K in your bank account, go ahead and distribute it, whatever that number is, and get on a habit of monthly distribution. So that's called the month-end working capital method. So those are two kind of easy rules of thumbs that some people find useful.
I love it. I love it. Let's step now and talk about the decision from a business perspective. So this comes into probably more the larger decisions about capital choices or where to reinvest back in the business or.
That's right.
And so, Kevin, I'll give an example here, story. One of our clients has a very successful company. They do things from roofing to solar energy projects for residential and commercial projects. Very successful company, really bright business owner. And he asked me, he said, David, sometimes it's hard to know, should I be hiring another high-end person to lead our marketing to the next level? Should I be hiring a VP of sales to lead our sales force to the next level? Heck, David, should I be hiring a fractional CFO or even a CEO to lead us to the next level of the promised land? And his comment was, it's hard to know where to do that, or should I just distribute out the money? How do I even make an ROI calculation? So I've got some thoughts to share. I'm curious how you go about thinking those things.
Yep. I'm so glad you brought this up. And so this is what Warren Buffett refers to as allocation of capital. And in fact, Warren Buffett's famous for his quote. He's famous for a lot of quotes, but one is, the most important skill, wealth building skill that a business owner needs to have is proper allocation of capital. So this means we have a certain amount of dollars and time and attention and talent and network. How are we going to use, this is all capital. How are we going to allocate that capital for the highest return? And he measures in how does it generate the most operating profit? That's how he defines it. And so you brought up some good examples. So some general rules of thumb is if you're going to invest in people, by year 2, you should be getting at least a 3-to-1 return on your people. Like they literally are going to generate at least 3 times the revenue, or depending on your type of business, gross profit, than your all-in costs on that person. By year 2, year 1 is an investment. CapEx, for example, the rule of thumb for normal CapEx, like equipment and those kind of things, is a 24-month payback, right, on CapEx. And then other ones can be made for investments or investment in business units, making an acquisition. A lot of times they're looking for at least a 30% IRR on that. Some will have a lower threshold and use 20%. Meaning
As I hear you say that, Kevin, it's interesting. So I every time we talk, I have something to write on and something to write with. I can't help but do it. I'm always getting new ones here. I'm going to come back and talk about that Buffett one at some later point with you. But I was writing out my little chart, how I think about this as we were talking. And so I've coached lots of business owners, and I've given them a rule of thumb. So first, we need to think of the scale of the business. So let's say it's a $10 million a year revenue business, 20% operating profit margin. So 10 million top of line, 2 million profit. It's probably a bread and butter client for you and for us.
That's right.
That kind of middle of the road company.
That's right. Bread and butter all day long. Yep.
And so the way I tell them is I'll say, look, if you're going to spend 50 or 100,000 or 125,000 on X, that should be paying for itself within a year, maybe 2 years, but probably pay back within a year.
Yep.
And then if it's a $250,000 to $500,000 expense for a business of that size, really 36 months is the longest you should be waiting for you to make it pay for itself. And then if it's over $1 million, you might be waiting 5 years, 7 years, possibly 10, but probably 5 to 7 years. And so when we go back into it, it's interesting. If it's a $70,000 new hire and they pay for themselves starting in year 2, that's 100% return on investment is what you're looking for from this person. Or if you're looking for a 3-to-1, we're looking for even a larger bar with that. If I'm looking for a piece of equipment, a new equipment, a 300 grand piece of equipment in my $10 million company, and I'm looking for it to pay back 24 months, 30, 36 months, that rate of return, I'm not going to take into account looking at IRR because I can't do that in my head. I need a calculator. But I can say that's a 50%, a 33% return on investment I'm looking for. the key with this, Kevin, I think we would both agree, and this is where business owners get it wrong. They think about ROI like they would an outside investment in a passive investment, like a stock or a mutual fund or something like that. And they think, well, if I made 10% on that investment, that would be really good. Whereas
Right.
inside of our business, which we have all the advantages, it's an active move. Really, I'm looking for 25, 35, 50,
That's right.
100% return on my money, where I get my cash back out and still have the asset producing even beyond there,
That's right.
which is in a different way. It should be, my feeling is it should be on the back of an envelope, so much of a no-brainer that I would be stupid not to make the investment, because the big risk is some of these moves won't work. Some of the hires won't work out. And the fact that I would be an idiot not to try it should cover for me for the times where I tried and it doesn't go.
That's right. Yep. And a couple of things there. One, you have to have a much higher risk premium. So exactly right. That's where that 30% minimum IRR, which stands for internal rate of return, how much do you make on it over time, annualized? And the reason that's important is you need that extra cushion for risk premium. But the other thing that folks can forget is like, hey, you've got overhead that's going to be allocated to this decision that you're not even thinking of. That's why that's going to actually reduce your return as you apply overhead in your company. But the measurement we use with our clients, and you and I work on a client, that's going to be the topic of our next CFO meeting, is return on invested capital. Of all the assets you have, what's your weighted return on that? In some cases, we've got they may be better off putting it in T-bills, and it shouldn't even be close to that, right? The return should be so much higher. That's exactly right.
Yeah. Kevin, there's a client that we both mutually share, and names don't matter. We'll call her Sally, just because we need a name. And Sally has an exceptionally profitable business, mid 7 figures she makes in profit. And her investment, she's built a significant net worth, right? Her net worth is investable outside the business, outside her home, 25 plus million bucks. And so you look at what her cash flow is from her portfolio of investments, it's negative $1 million plus.
Yep.
So she's using her active business to feed this part. And what I learned is the other side is that many business owners, they get really good in their business and they go too hard outside their business to try to go for those extra percentage points.
Yep.
But then they don't admit to themselves when they don't have advantages for it, where they would be better off in T-bills. As a worst case scenario, you're not losing cash flow, you're making enough to at least cover inflation in most cases. Yep. So your comment about capital allocation, it's skill, but I think that if I gave any one piece of advice to a business owner, is you need 2 or 3 outside the company sets of eyes whose paychecks don't rely on them saying what you want to hear, who will tell you what you need to hear directly, forcefully if need be, gently if need be, so that you don't make dumb moves and make your life harder.
Yeah, that's exactly right. And investing outside the business is super important. But to your point, if you can't create alpha, if you don't have advantages to significantly outperform the markets, it's a waste of time. And you probably don't have it, right? Your business skill is not the same as an investment skill in a completely different asset class. And I used to, subscribe to the Investor's Business Daily and do some trading, and I slightly outperform the market most of the time. But if I look at the dollars, my return on time was bad alone. And furthermore, that was time that I was not spending in my business where I could get a much higher internal rate of return. So that was some wasted time where now I only do index ETFs, and I come up with an asset allocation and I just spend minimal amount of time rebalancing, and much better use of my time, and I make a lot more money and have a lot more to invest as a result.
And quite frankly, a lot less stress from it, because I would imagine this is true for you. I know it's true for our business coaching clients that over time, each subsequent year, the business tends to become more enjoyable to own.
Absolutely.
Because you have better staff, better systems, less responsibilities on your shoulders as you've made the business fit you versus you fitting the business.
And a lot more wisdom to deal with it. And so learned the hard way. Yeah. And so all that other effort was really wasted in a horrible, horrible return on time. Yep.
So Kevin, I want to ask what you would hope that their big takeaway from today is going to be. I'll share first what I'm hoping their big takeaway is going to be. So what I'm hoping that their big takeaway is going to be, which is don't be shy about pulling profit out of your business. That is something you've earned with that part. especially when it's the choice between, well, should I make these vanity purchases inside the business or not? The people I've known who have been most happiest, most successful over the long run as a business person, heading into semi-retirement or even retirement. We've been doing this now long enough. We see enough of those of our clients after the sale of the company, if that is their chosen exit. And what I'll share with the takeaway from my end would be, if I can avoid those vanity or stupid ego purchases and yet distribute money and then just do simple things to invest outside the business. Yes, I should reinvest in the business with some things, but most business owners that we coach, their business doesn't require nearly as much capital as it's spinning off. And
That's
so a
right.
much better move is to take it out of the business versus letting it stockpile there, and to just do some simple structured things over the long term to build that wealth outside the business. It builds disciplines, it builds peace of mind, it builds more options later on, skills for later on. And those, I think, business owners who do that are happiest and most successful long term. What would your takeaway be?
Yeah, exactly right. I was going to close with exactly that. Is taking regular distributions is an absolutely appropriate, necessary, and healthy thing to do. And you want to do it in an intentional and disciplined way. And I recommend at least monthly with some allowances for seasonality. Number of reasons for doing it. Folks that leave it in, and it can often get unintentionally sucked back into the business. Or one of the most common lies is business owners saying that they've reinvested in their company, which is a giant lie that is overused, when in reality it means you didn't make the money in the first place. So you didn't make it if you don't take it. And the other thing is, any asset protection, a lawyer will tell you in the first line of their speech that one of the most dangerous places you can leave cash in the United States of America, where lawsuits are as regular as brushing your teeth, is in the operating company of a business. You need to keep it out. That working capital is absolutely exposed and is better spent elsewhere. And then finally, to your point, you should be reinvesting that outside the business and should have a certain amount of liquidity outside your business, as the lessons of 2008 and 9 reminded everybody. Yep.
As always, Kevin, it's a blast to have you and I get a chance to talk. So I appreciate you co-hosting today with me here on The Business Coach.
Yep. As always, a pleasure. See you next time.
All right. See everybody next week. Thank you for joining us for this week's episode of The Business Coach. See you next week.
Thanks.